Alrighty, we're here with Philip Taspall. Philip, thank you so much for coming on Attributions. It's great to have you on here.
Pleasure. Thanks for having me.
So before we get started, Philip, I'm just wondering if you can give us a little brief background about yourself on, what you're specializing in or whatever else you think is important.
Yeah, sure. So I work for a company called XDI. They're an Australian company by origin, but have grown over the last 10, 15 years to cover clients around the world. And we specialize in the analysis of climate-accelerated physical risk to build assets. So helping our clients to understand how climate change might impact their investments, their homes. So we work with everyone from banks to asset managers, super funds, anyone with a material interest in the long-term viability and value of build assets. And we also have a broader agenda on helping quite a wide range of stakeholders to really understand the risks of climate change, how we might best respond. And so we do a lot of non-commercial work with regulators and other policymakers to kind of help move the system along so that we get the best response to this challenge.
Great. So now, XDI, your company, they have put out this report that I wanted to talk about today, which is titled the 2024 XDI Asia Pacific Real Estate Investment Trust Physical Climate Risk Report. And I think it would be actually first helpful to probably define a few terms. So I'm just wondering what is meant by real estate investment trusts. Now, this term might be a little confusing for some people who are unfamiliar with the space. So I'm just wondering if you can expand on that a little bit.
Yeah, so a real estate investment trust or a REIT is a specially designed financial vehicles that was set up by some innovators that essentially allows anyone to be able to invest in commercial property without really having direct ownership of the asset. So what I mean by that is you buy a unit in the trust, but you don't necessarily hold the asset directly. So it's a way of constructing a portfolio that people can buy into in a way that means that they can, for a very relatively small amount of money, get exposure to commercial real estate. So this might be like office towers, data centers, logistics, industrial property, and there are special features about a real estate investment trust, which means that they're very efficient in terms of the way that they distribute their dividends, the way that they set up their financial structure. So they're generally seen as a conservative and stable asset class, and a way for people who could not afford to buy an entire shopping mall but gain financial exposure to one. So they're part of a broader investment class that you would typically call real estate or infrastructure, but specifically these trusts are set up in such a way that people can buy in and pretend they're institutional investors for a day. So that's their typical purpose.
And what kind of dollar figures are we talking about here? Are there kind of estimates on how much these investment trusts are worth in terms of when we're speaking in the global economic sphere?
Yeah, so trusts, real estate investment trusts themselves are a subset of a much, much bigger global real estate market. So our research tended to indicate that the total value of listed real estate within these trusts is about $4 trillion globally. Sounds big, but I was sort of doing a little bit of reading before we caught up, and a report by Savills, who are a big sort of global property services company and investment advisory firm, estimate that the total value of real estate globally is more around $400 trillion. So the reason we selected real estate investment trusts was not so much because they're REITs on their own, but because they are vehicles that are quite easy to analyze. So what I mean by that is that they're quite transparent. So they disclose a lot of their asset profiles. And so for us, we were able to sort of draw down on those public disclosures and then analyze the assets for physical related climate risk. But the point we're making in this report that we've released that you mentioned is really more about global real estate more broadly, and indeed economies more broadly. So I guess you could interpret REITs as a case study or a way in which to elaborate on a broader point.
Now, when we talk about climate risks to these trusts, or as you just said, real estate more broadly, how would you say that this conversation has kind of evolved over the years? Like, it's not one of the foremost topics that you would normally see on, say, the front page news, for example. So I'm just wondering if, from your perspective, how has this become more of a prominent issue as time has gone by?
Yeah, it's really kicked up a gear in the last 5 years, I would say. And I would say the underlying drivers for that would be conversations around climate change have moved from ones that sat predominantly in the environmental sphere to ones that are now concerning people in the economic financial systems and how climate, and trying to understand how different aspects of climate change may affect the financial performance of assets or the banking system or financial system. So it's sort of shifted a lot, and with that has come a change in expectations around the amount of disclosure that a company needs to make about climate risk to its asset base, or what its investors expect to understand about their investments. And I've been working in and around this space for 20 years, and I remember if you saw one article in the Australian Financial Review, you'd sort of cut it out and keep it in a scrapbook because it was so rare. But now it's almost impossible to keep up with the amount of commentary and the amount of reports, the focus that this subject is getting. You're right, it's probably not front page news every day, but I don't think there'd be a CEO or a board in any of the big listed companies in Australia who weren't looking at their response to this subject quite seriously, and indeed globally.
Now, of course, climate change and extreme weather events can vary significantly. I'm more interested in, what the report details, like what are the kind of hazards that the report expects to be the most influential as we go into the future to real estate in general.
Yeah, so the hazard risk profile of an asset is very location dependent, and it's also dependent on the time horizon that you choose to look at. So if you're, let's take a real estate investment trust, for example, that has logistics assets which may be concentrated around ports. So there's a few big ones around, and they will choose strategically to invest in industrial assets, warehouses, logistics assets that sit around transport hubs and particularly ports. Now, if you cast forward into the second half of the century, you can see that under some climate change scenarios that the impacts of sea level rise, for example, on those assets becomes quite material. If you were to pick an asset that was in a city or a country that is prone to typhoons or cyclones, then the risk profile changes again. And equally, if you're thinking about cities that are built in river basins, they can and have been shown to be prone to flooding. So it really depends where the asset is, the country, and increasingly, we're talking to a bunch of clients around Asia. It's not just established assets that we should be thinking about. Is like, how do you actually construct and develop more assets, and the impact of heat stress on construction workers, for example, is something that's quite serious throughout Asia. And you can see a number of governments wrestling with how do you maintain business continuity in a time when the heat stress being placed on workers is intolerable.
That actually it's a nice segue into actually what I wanted to talk about next. Is the report, it does focus quite heavily on the Asia Pacific region in general. And I just wondered, from your perspective, how, if you think that the region is unique in terms of exposure to climate risk, and do you think that, for example, and you mentioned you alluded to this before, but depending on the region, that some risks are different, say Singapore compared to Australia, for example. But I guess more generally speaking, do you think that the Asia Pacific does have unique features in terms of risk to climate change?
Yes, it does, and it's a good question. One people really need to bear in mind when we think about who suffers most from the risks of climate change. I mean, we're talking about property, but there is this huge populations that are vulnerable to climate change throughout the region. And when we did some analysis of the relative risk of 2,600 provinces globally, so we cut the world up into sort of that's kind of scale, and 50% of the highest risk provinces were in Asia. So India, China, particularly Southeastern China. Southeast Asia shows the highest and increase in risk profile over the next 30 years. And we're seeing that from flood, from obviously cyclone, typhoon, and then in the second half of the century, sea level rise. And, our report looked at sort of physical assets to create a proxy for climate change risk. But if one was to expand the analysis out further and look at water stress, heat stress, I think it would even show even higher risk in the Asia region. So it is sadly a part of the world that will be most impacted. It's probably contributed the least historically to climate change, and it has some of the most vulnerable populations which may not be best equipped to deal with it or respond to it. So it's a complex challenge.
Now, of course, the report isn't all doom and gloom, and it does give some tangible ways to reduce these risks in the sector, and I wanted to go over them with you. I guess the first one was what you mentioned, what the report mentions as screening for assets most at risk, and then doing what the report calls a deep dive on the asset. I'm just wondering what would that specifically entail, for example?
Yeah, sure. So the work that we do at XDI uses what we call a structural model, or it's analysis based on engineering principles. So the way that we help our clients is to replicate the structural attributes of their assets within our models, and then stress test those digital twins of those assets so that we can start to see where they might fail or how they might perform. And so we're essentially able to understand the thresholds at which extreme weather will damage an asset or cause it to fail. And we can do that under different climate change scenarios. So, your listeners would understand that there are different trajectories that are in play here. So if the world is successful in decarbonising its economy, then the risk profile of these assets remains quite low because we've managed to avert the worst implications of climate change. Whereas if we fail in that front, then we start to see these costs rise quite dramatically. So we can present this information in under different scenarios and really create a business case, for decarbonisation, but also forward planning. And you're right, with a combination of those two things, in other words, if we successfully decarbonise the economy, prevention is the best cure in this case. That's one. And then second, if these asset owners are able to get ahead of the curve quite quickly, then they can start to plan their forward capex and say, well, in a portfolio of 100 assets, say 10 of these are showing high risk. Flood is driving the problem, or sea level rise is driving the problem. These are the things that we would need to do at a certain point of time to intervene to ensure the ongoing resilience and therefore value and ongoing operational viability of those assets going forward. So that's the kind of work and advice that we provide to our customers.
And then you've got, I think, following that. And I mean, these all work synergistically together, these steps. But then you've got step 3 and 4. They talk about adaptation, and especially what the report calls for quote offsite and cross dependency analysis. And I thought that was quite important as well, because that kind of just demonstrates the interconnectedness of all these different systems at play. So I'm just wondering if you could just expand on that a little bit.
Yes, there's multiple challenges to this analysis, and one of them is certainly the boundary that you put around it. So we can analyze someone's home very precisely, for example, but then that home or someone's office might be dependent on an access road or a train line or a power station. The the water mains, for example, for that area or that asset to remain viable, depending on how you define viable. Well, it's certainly economically and socially. So that the cross-dependency analysis takes those extra factors into account. So you're not just focused on analyzing a single asset at a single point, but you're understanding the risk profile of the city or the region that sits around it and the infrastructure upon which it's dependent. So that's work that we've done historically with particularly governments and city planners who are trying to get their head around really long-term risks to make sure that the plans they're putting in place now means that the infrastructure they're designing for is resilient into the future. And anyone really with that long-term horizon tends to respond to that kind of work. So big real estate asset owners often take a city or a suburb view on risk, and increasingly we're seeing this topic bleed into home ownership. So mums and dads, we actually have a product where people can go online and check the climate risk profile of their home and the surrounding area. So this could become something that people factor in when they're actually buying a home and thinking about what they want to pass on to their kids.
Yeah, and I think this kind of also ties into the supply chain and analyzing all those other issues involved with, making sure that, for example, after an extreme weather event, you've got access to, clean water, for example, or access to roads and things like that. Would you say that all kind of ties in together, and then it goes into this other step, which you mentioned, and it creates this little circle where it says investing in green infrastructure, which I think it all comes back around. I guess my main question would be that when you talk about investing in more green infrastructure, do you think that this is more or less viable on a large scale, given that a lot of infrastructure projects have, kind of set standards already, or that retrofitting them, it can come at a really high cost, or is just unviable due to, certain circumstances?
Yes, certainly one wouldn't want to create the perception that we can adapt our way out of this problem. That's not really an answer when you look at the potential impacts of climate change, particularly when you're talking about high emission scenarios if we were to fail to decarbonise the economy. So if we don't achieve those decarbonisation goals, we can't simply fall back on the idea that we can adapt our way out of it. So it is, as I said, a combination of prevention being the best cure here, and really focusing and doubling down on those decarbonisation efforts that we're seeing across governments and corporates and banks, etc. And then I guess you call it the residual risk, the bit that can't be mitigated in that way. Some of those assets will be adaptable, and part of the work that we do is to assess what the cost-benefit analysis of that might be. So what's the cost of expected future damage under extreme weather accelerated for climate change versus the cost of expenditures on adapting the asset. So that trade-off that you highlight is something that the long-term planners will take into account. So that's really for existing assets. That's where it's like, I already own something. What am I going to do about it? And then there is obviously new assets. So how do we get planning right? How do we ensure that the standards that we're setting for infrastructure now are going to be suitable for resilient infrastructure in the future under climate change, which sadly, no matter how much work we do on decarbonisation, there is still some climate change locked into the system, which we'll need to plan for.
And Philip, would you say, with your work, has there been any standout players based on your research, or based on your knowledge of different cities taking pretty impressive approaches to these kind of planning issues, or any kind of even asset managers, for example, or any kind of banks, for example? Has there been any positive signs that you've come across in your work?
Yeah, if we zoom out on the climate agenda a bit more broadly, not just on physical risk, but we're thinking about responses. I think to that decarbonisation challenge, I think the banking sector has finally stepped up in many ways around setting targets to decarbonise their lending portfolios under aggressive decarbonisation strategy. So that means not lending to certain things, not propagating certain fossil fuel activity that they might have in the past. Now, whether you could question whether that's going fast enough, but it has shifted immeasurably in the last 2 to 3 years around some particular industry platforms that the banks work to. Regulation is driving it a lot. So there's not only the national targets that countries have signed up to, but also disclosure and corporate reporting requirements, which seek to lay bare the relative risk of companies' climate change risk profile. So, in time, what we hope to be able to see is that investors will be able to very clearly see which companies are performing better in this space. So regulation's another important driver. And then I think people are starting to see that there's a business case here. So if we go back to the beginning of this conversation with real estate investment trusts, some of these trusts or real estate companies have been at the forefront of sustainability for a very long time, and they've worked out that it's a business advantage because they can create asset portfolios that outperform relative to their peers. By that I mean they might be more energy efficient. If they're more resilient, that leads to tenant retention. These trusts are all set up to continue to have long-term rental income streams that they pay as dividends to their unit holders. So if you can bring in really high caliber tenants and retain those because your assets are top of the class, then there's this inherent business case for having a strong response to climate change. So I would say that actually some of these REITs have been and continue to be strong performers. I think we do a lot of work with the New South Wales government. They've been clearly quite progressive in the way that they're using our analysis to plan out infrastructure and water infrastructure. But I think globally we're seeing an increased recognition that long-term planning for climate change is now a fact of life, and green infrastructure often means access to beneficial forms of financing. And so there's a system emerging around this, which means hopefully we see that virtuous circle that you alluded to, where better practice attracts better finance, it attracts better outcomes.
Well, Philip, thank you so much for your time, and it's been very interesting talking to you. I think this is a conversation that is ongoing and developing. But before we sign off, is there anywhere that you would like to point listeners to go to? So maybe where they could find the report, or for example, you mentioned that even homeowners can assess their real estate risk, for example. That might be something of interest.
Yeah, there's probably two places to go. One would be XDI.systems for access to a couple of those reports that we discussed today. And then if people are interested in a free site check of their home to see whether their property is potentially at risk from some of these things that we've discussed, then go to climate valuation. Just Google that, and hope you find it useful. So thank you very much for having me.
Awesome. Thank you, Philip. Until next time. If you found this episode of Attributions valuable, please don't forget to subscribe to our podcast channel, follow us on social media, share it with your friends and with your network, and visit our website at www.climateimpactstracker.com for articles and more. Thanks again for listening, and I'll see you again on the next episode of Attributions.